Welcome to Personal Finance Deep Dives, where we help you make your money work for you. Today, we're taking a deep dive into one of the most significant financial commitments many of us will ever make. Understanding mortgages. It's a term we hear all the time, right? But do we truly grasp what it entails? It can seem pretty complex.
That's absolutely right. A mortgage is often the gateway to homeownership for most people.
hmm
And it can seem incredibly complex, maybe even a bit daunting, especially if you're navigating it for the very first time. But we're here today to unpack all the essential details, guide you through how mortgages work, what they really involve, and why it's so critical to understand them.
Exactly. Our mission for you today is to cut through the jargon, make sense of it all, and equip you with the fundamental knowledge you need so you can feel confident about this huge step. We'll cover what a mortgage truly is, the step-by-step process of getting one, what you're actually paying for each month, and the different types of mortgages out there, along with some key terms you'll definitely encounter.
Yeah, we want to give you that clarity and insight, help you make informed decisions for your financial future. So let's get started. Let's dive in.
Okay, let's start with the absolute basics then. What is a mortgage at its core?
Simply put, a mortgage is a type of loan you use to purchase real estate. That could be a house, a condo, maybe even a plot of land. It's essentially a way to buy a property without having to pay its entire price upfront in cash, which, let's face it, most of us can't do. The crucial element here, the thing that really defines it, is that the property itself serves as collateral for the loan.
Collateral. Okay, so if you don't pay, the lender has a claim on the property itself. That's a pretty significant detail, isn't it?
Absolutely. It's fundamental. It means if you fail to repay the loan, as agreed, if you default, the lender has the legal right to seize the home. That process is called foreclosure. So while you are the homeowner, you live there, you can renovate.
Hmm.
You don't truly own it free and clear until that mortgage is fully paid off. The lender has a stake.
Right. The lender holds that power until the very last payment. I've also heard the term deed of trust used sometimes. Is that the same thing or something different?
That's a great question. In some states, yes, the legal document that outlines the loan terms and allows the lender to seize the home if you default is called a deed of trust. Functionally, for the borrower, it serves the same purpose as a mortgage document. It's just a different legal instrument depending on state law. And fun fact, the word mortgage itself actually comes from Old English and French. It essentially means a death vow.
Wow. Death vow. That's dramatic.
It is, because the loan dies, it ends when it's fully repaid, or, well, when the borrower defaults. A bit grim, but it highlights the commitment.
Definitely highlights the commitment. So thinking about that huge cost of a home, most of us aren't sitting on, hundreds of thousands of dollars in cash. So how exactly do mortgages bridge that gap? Why are they so essential?
That's the core reason they exist, really. Home prices are often far, far greater than the savings most households have readily available. Mortgages make homeownership accessible. They allow you to put down a smaller initial amount that's your down payment and then borrow the rest, the bulk of the cost. This spreads that massive cost of a home into manageable, regular payments over many years. Typically 15 to 30 years is common, though other terms exist.
So it breaks down an impossible upfront cost into something doable monthly.
Exactly. Without mortgages, homeownership would honestly be out of reach for the vast majority of people. The market would look completely different. Takeaway number one, the essence of a mortgage. So remember, a mortgage is a loan secured by the property itself, making ownership possible by spreading the cost. But the lender holds that claim until it's paid off.
Okay, so we know what it is and why it's so fundamental. When is the right time to actually get one? When should someone start thinking seriously about this?
Well, the time to get a mortgage is pretty straightforward. It's when you're looking to buy a house or other property, but you can't afford to pay the entire price in full, up front, with cash. It allows you to offer a portion of the home's value as that down payment and then borrow the remainder from a lender, like a bank or credit union. You then repay this borrowed money plus the interest over that agreed-upon term we mentioned.
Right. But before you even think about looking at houses online or going to open houses, what essential groundwork should people be doing? What's the crucial prep work?
The first, and I mean the most critical step, is getting your financial house in order. Seriously, you absolutely need to check your credit score and review your credit report thoroughly. Go through it line by line. Lenders will scrutinize both of these things very closely to determine your interest rate and, frankly, whether they'll even lend to you. The healthier your credit score, the lower your interest rate will likely be. And that directly translates to lower monthly mortgage payments for you. We're talking potentially thousands saved over the loan's life.
Okay, so check the credit score, check the report. What if your score isn't quite where you want it to be? Are there concrete things you can do to improve it before applying?
Absolutely. You're not just stuck with the score you have. You can definitely take steps to boost it. Paying all your bills on time, every time, is paramount. That's the biggest factor. Also, try to pay down existing debt, especially credit card balances. Keep your credit utilization low. That's the amount you owe compared to your credit limits. Under 30% is good. Under 10% is even better. And there are even some services now, they can link to your bank accounts. They look for regular utility or subscription payments, things not normally on your credit report.
Yeah.
And they can use that consistent payment activity to help increase your FICO score. It shows broader financial responsibility.
Oh, that's interesting. Using things like utility bills.
Exactly. And also, make sure there are no errors on your credit report. Dispute any inaccuracies immediately, as they can really drag your score down unfairly.
Good advice. So, once our credit is looking good, what's the next step in the actual application process? Where do we go from there?
Okay, after preparing your credit, you'll want to start thinking about the type of mortgage that suits your needs and, importantly, the loan term you're comfortable with. Most lenders offer terms ranging from, say, 10 years up to 30 years. 15-year and 30-year mortgages are definitely the most common choices. Now remember the trade-off. The longer your loan term, like 30 years, the smaller your monthly payment will be. That feels more manageable day to day, but you'll end up paying significantly more in total interest over the life of the loan.
Right, whereas a shorter term, say 15 years.
Exactly. A shorter term means higher monthly payments, which requires more budget discipline, but you pay off the loan much faster and pay way less total interest. Big savings in the long run.
So choosing the term involves balancing that monthly affordability against the overall long-term cost, a really key decision. What comes after you've thought about the term?
Next, you'll research and identify potential lenders. Don't just go to your everyday bank automatically. There are many options. Traditional banks, credit unions, online-only non-bank lenders. They each have their own pros, cons, rates, and qualification criteria. Shop around. Once you have a sense of a few potential lenders, it's time to get pre-approved for your mortgage loan. And this is crucial.
Pre-approval. Okay, we hear that term constantly in real estate. What does it really mean, and why is it considered so important?
Pre-approval is basically where a lender gives you a formal letter stating that, based on their initial review of your finances, you're approved to borrow up to a specific amount of money, usually at a particular interest rate range, to buy a home. It's highly, highly recommended you go through this process before you even start seriously visiting homes.
Before looking, why so early?
Because knowing how much you can truly afford from the outset is vital. It sets your realistic budget, prevents you from falling in love with a house you can't afford, and, critically, it shows sellers and real estate agents you're a serious, qualified buyer. An offer with a pre-approval letter is much stronger. For this, lenders will look closely at your FICO score, your credit report, your income, your employment history, your debt-to-income ratio, and your planned loan-to-value ratio. They do a preliminary check.
And this pre-approval isn't forever, right? It has an expiration date.
Yes, that's right. Pre-approval letters are typically valid for maybe 60 to 90 days, so it does put a bit of a clock on things. This means you'll want to start your home search relatively quickly once you have that letter in hand. After you find a home you love, make an offer, and the seller accepts it, then you'll submit your full, formal mortgage application to the lender you've chosen. And that's usually a much more detailed multi-page document asking for comprehensive financial information, way more in-depth than pre-approval.
Okay, got it. Now, can you apply to multiple lenders for that full application without tanking your credit score? Is that a good strategy?
Yes, you absolutely can, and frankly, you probably should apply to multiple lenders. It's smart shopping. Just make sure to submit all those applications within a relatively short time frame, say about 45 days or so. If you do that, the credit scoring models usually recognize your rate shopping for one single loan, and it will typically only count as one hard credit inquiry on your credit report.
Ah, okay, so it minimizes the hit to your score.
Exactly. And it allows you to compare actual loan estimates side by side and pick the lender offering the best overall deal rate, fees, the whole package.
Smart. So what happens once the full application is submitted to your chosen lender? What's the next phase?
That kicks off the loan processing stage. Your chosen lender will thoroughly review everything you've provided. They'll often request additional documents, maybe more tax forms, recent pay stubs, bank statements that verify all the information you submitted. They double-check everything. It's also important to note here that your initial mortgage lender, the company you applied with, known as the mortgage originator,
Right.
they might not always be the company you make your payments to long term.
Oh, how does that work?
Well, many lenders sell the servicing rights to your loan to another company. That other company then handles collecting your monthly payments, managing your escrow account, sending statements, etc. The terms of your actual mortgage, your interest rate, your loan length, those should remain exactly the same. It's just who you send the check to might change. Don't be alarmed if that happens.
Good to know. And then there's something called underwriting. That sounds pretty intense.
It is the intense part, yes. Underwriting is where an underwriter, a specialist at the lender, takes that fine-tooth comb to everything. They meticulously review all the financial factors that could influence your ability to make payments on time, your income, your assets, your debts, your credit history. They also look at the property itself, primarily the appraisal, to ensure its value supports the loan amount. And they'll double-check that the home's title is clear.
Clear title. What does that mean?
It means making sure there are no hidden liens or claims on the house from other parties, like old debts, unpaid contractor bills, or property line disputes. They want to ensure the seller truly has the right to sell it free of entanglements. You might see a title fee in your closing costs to cover this search and insurance.
Okay, so the underwriter is like the final gatekeeper for the loan approval.
Pretty much, yes. Their approval is the final hurdle before the loan is officially greenlit.
So once everything clears underwriting, what's the absolute final step before you get the keys?
Once underwriting gives the okay, you'll schedule a closing date. This is often coordinated with the seller, your agent, and the title company or attorney. Then, legally, at least 3 business days before that closing date, you'll receive a document called the Closing Disclosure Form.
Closing disclosure. That sounds important.
Extremely important. This critical document lists out all the final costs of your mortgage, the exact loan amount, interest rate, your final monthly payment breakdown, PITI, all the fees, closing costs, everything. This is your chance to meticulously review every single number and ensure it perfectly matches what you were told in the loan estimate and what you agreed to.
So check it very carefully.
Very carefully. Ask questions if anything looks off before closing day. Then, on closing day itself, you'll sign this disclosure, along with a mountain of other paperwork. Funds are transferred, the deed is recorded. And finally, after all that signing, you become the proud owner of your new home and, of course, a new mortgage. Takeaway number 2, navigating the mortgage application journey. Remember, it's a step-by-step process. Start with credit checks, get pre-approved to know your budget, apply thoroughly, shop around, go through processing and underwriting, and crucially, review that closing disclosure before the final signing.
Okay, so you've done it. You've got the mortgage, you survived closing. Now let's talk about that monthly payment. What exactly are we paying for each month? It's not just paying back the loan amount, is it?
You're absolutely right. It's usually more than just the loan repayment. Your typical monthly mortgage payment is made up of 4 key components. We often use the acronym PITI to remember them: principal, interest, taxes, and insurance.
PITI. Okay, let's break that down. Let's start with the P for principal.
The principal is the original amount of money you borrowed to buy the house, the actual loan amount. Each month, a portion of your payment goes directly towards reducing this principal balance. This is how you slowly chip away at the debt and build equity or ownership in your home over time. So if you put 10% down, you start with 10% equity. Every principal payment you make increases that percentage, bit by bit.
Got it. That's the part that actually pays down the debt. Now, the first, interest, this is the lender's profit, essentially, the
Right.
cost of borrowing.
Exactly. The interest is what the lender charges you for the privilege of borrowing that large sum of money. It's calculated based on your interest rate and the outstanding principal balance. Now, here's what's fascinating and often surprises people. In the early years of your loan, especially a 30-year loan, the majority of your monthly payment goes towards paying interest.
Really? Most of it.
Yes. Only a smaller portion actually reduces the principal balance early on. As you get further into the loan term, that balance shifts. More and more of your payment starts going towards principal and less towards interest. This whole process, this scheduled shift, is called amortization.
Amortization. So you build equity much slower at the beginning.
Precisely. It feels slow at first, but it accelerates over time.
Okay, then we have the T for taxes. Property taxes. I know homeowners pay these anyway, but how do they get bundled into the mortgage payment?
Right. So property taxes are levied by your local government. When you have a mortgage, your lender often sets up what's called an escrow account. They'll estimate your annual property tax bill, divide it by 12, and collect that amount from you each month along with your principal and interest payment. This money sits in the escrow account, and then when your property taxes are actually due, maybe once or twice a year, the lender pays the bill on your behalf directly from that account.
Ah, so they manage it for you. That sounds convenient.
It is very convenient for budgeting. It smooths out a potentially large annual expense into smaller monthly chunks. Just be aware, your lender might require you to pay a few months' worth of taxes up front at closing to seed the escrow account. And your escrow payment can change yearly if your taxes go up or down.
Okay, makes sense. And finally, the second I for insurance. This is homeowner's insurance.
Yes, homeowner's insurance. Lenders almost always require you to have this. Why? Because the house is their collateral. They want to make sure their investment is protected against damage from things like fire, storms, certain types of water damage, accidents, etc. Similar to property taxes, a portion of your annual homeowner's insurance premium is typically collected monthly with your mortgage payment and held in that same escrow account. The lender then pays your insurance bill directly when it comes due.
So PITI covers the loan itself, the cost of borrowing, property taxes, and homeowner's insurance, often managed through escrow.
Got it. Now, what about private mortgage insurance, PMI? Is that part of PITI? Where does that fit in? Good question. PMI isn't technically part of the PITI acronym itself, but it's a very important additional monthly cost that many homeowners pay, especially first-time buyers. It's typically required if you make a down payment that is less than 20% of the home's purchase price.
Less than 20% down means PMI. Okay. Why is it required? And who does it actually protect? Because it feels like an extra burden on the borrower.
It absolutely feels like an extra burden, and here's the crucial thing to understand. PMI does not protect you, the homeowner. It protects the lender.
Only the lender.
Only the lender. It mitigates the risk for them in case you default on your loan, particularly when you have less skin in the game initially with a smaller down payment. The costs can vary, but they might range from, say, 0.5% to maybe 1.5% of your original loan amount annually, broken down into your monthly payment, so it can add a noticeable amount to your total housing cost.
Okay, so it protects the lender, costs extra money. How do you get rid of it? Can you eventually stop paying PMI?
Yes. Thankfully you can, and you should aim to. Once you've made enough payments and/or your home's value has appreciated enough that you have built 20% equity in your home, meaning your loan balance is 80% or less of the home's value. You can usually request that your lender cancel the PMI.
You have to request it. It doesn't just stop.
Often you have to formally request it, yes. They might require proof of value, like a new appraisal. Sometimes, by law, it must be automatically terminated when you reach 22% equity based on the original value and amortization schedule, but proactively asking once you hit 20% is usually faster. Refinancing your mortgage is another common way to get rid of PMI if you have sufficient equity. Getting rid of PMI should definitely be a goal once you hit that 20% equity mark. Takeaway number 3. Deconstructing your monthly mortgage payment. Remember PITI, principal, your equity builder, interest, a borrowing cost, high early on, taxes, and insurance, often via escrow. And if your down payment's under 20%, you'll likely pay extra for PMI, which protects the lender, but aim to cancel it once you hit 20% equity.
All right. Beyond what's in the payment, I know there are different fundamental types of mortgages. Can you explain the main categories, like how the interest rate works?
Absolutely. The two broadest categories you'll encounter, which really define the loan's behavior over time, are fixed-rate mortgages and adjustable-rate mortgages, usually called ARMs.
Fixed rate. That sounds pretty self-explanatory, stable, predictable.
It is, exactly. With a fixed-rate mortgage, the interest rate stays exactly the same for the entire term of the loan, whether that's 15, 20, or 30 years, locked in. This means your monthly principal and interest payment will remain consistent, totally predictable throughout the entire life of the loan, though your total payment could still change if taxes or insurance and escrow go up or down. This stability is why it's overwhelmingly the most common type of home loan. People like knowing exactly what that core payment will be month after month, year after year.
Makes sense, especially for long-term planning. So an adjustable rate mortgage, an ARM, that sounds like the opposite, more risk involved.
Precisely. With an ARM, the interest rate is fixed only for an initial period, maybe 5 years, 7 years, 10 years. After that initial fixed period ends, the interest rate can change periodically, usually once per year, based on prevailing market interest rates plus a margin set by the lender. This means your monthly payment could go up, potentially significantly, or could go down, though historically rates tend to rise over long periods. It introduces uncertainty.
Okay, uncertainty. So what's the appeal of an ARM then? If the rate can jump up, why would someone choose that?
The main appeal is that the initial interest rate on an ARM is often noticeably lower than the rate on a comparable fixed-rate mortgage at that same time.
Ah, a lower starting payment.
Exactly. A lower initial rate means a lower initial monthly payment, making it more affordable in the short term. This can be attractive for someone who, say, plans to sell the house or refinance the mortgage before that fixed rate period ends and the rate starts adjusting. Maybe they know they're moving in 5 years. ARMs usually have limits or caps on how much the interest rate can increase each time it adjusts, and also a lifetime cap. So there's some protection, but payments can still climb substantially. A common example is a 51 ARM fixed for 5 years that adjusts annually.
So ARMs are maybe better for shorter-term homeowners or those comfortable with rate risk, while fixed rate is better for long-term stability.
Generally, that's a good way to think about it.
Now, within those fixed or adjustable structures, there are also specific loan programs, right? Like FHA, VA. Can you tell us about the common ones?
Yes, absolutely. These programs often cater to specific borrower needs or circumstances, sometimes making homeownership possible for people who might struggle to qualify otherwise. Let's run through the main ones. Conventional loans. These are sort of the standard, most common type. They aren't backed by the government directly, but follow guidelines set by Fannie Mae and Freddie Mac. You generally need a decent credit score, say 620 or higher, and a down payment of at least 3%, though 20% avoids PMI.
Okay, the standard option.
FHA loans. These are insured by the Federal Housing Administration. They're designed specifically to help borrowers who might not qualify for a conventional loan. Maybe they have a lower credit score. You might qualify with a score down to 580 or a bit more debt. They allow a low down payment of just 3.5%.
So more accessible for some.
Definitely. The trade-off is they require mortgage insurance premiums, MIP, both upfront and annually, which can sometimes last for the life of the loan, unlike PMI on conventional loans. VA loans. These are fantastic loans guaranteed by the U.S. Department of Veterans Affairs. They offer huge benefits for qualified veterans, active duty military, and eligible surviving spouses. The biggest perk: often no down payment is required, zero down, and typically no ongoing mortgage insurance. Rates are usually very competitive, too.
Wow, zero down is huge.
It's a major benefit earned through service. There's usually a one-time VA funding fee, but it's often worth it. USDA loans. These are backed by the U.S. Department of Agriculture. They're aimed at helping people buy homes in designated rural and sometimes suburban areas. Like VA loans, they often allow for zero down payment, which is amazing. Borrowers do need to meet certain income limits for the area, though, to ensure the program targets moderate-income households in eligible locations.
Okay, so specific locations in income levels for USDA.
Right. And finally, jumbo loans. These are simply mortgages for loan amounts that exceed the standard conventional loan limit set by the government. You need these for buying very high-priced properties. Because the loan amounts are larger, lenders often have stricter requirements, higher credit scores, larger down payments, more reserves.
Got it. Covers the spectrum from accessible government programs to high-end jumbo loans. Are there any other, maybe less common or more specialized types we should just briefly be aware of?
Yeah, there are a few others you might occasionally hear about, though they're less mainstream. You might see interest-only loans or payment option ARMs. These can have complex structures. Interest only means for an initial period you're only paying interest, not principal, leading to very low initial payments. But your principal balance isn't decreasing, and eventually your payments will jump significantly when you start paying principal. Or you might face a large balloon payment at the end where the whole balance is due.
Sounds risky.
They can be very risky if you don't have a solid plan. They were more common before the 2008 crisis and contributed to problems then. Generally only suitable for very sophisticated borrowers who fully understand the risks. Then there are reverse mortgages. These are quite different. They're designed for older homeowners, typically age 62 plus. They allow you to convert some of your home equity into cash, maybe as a lump sum, monthly payments, or a line of credit without having to sell your home.
So you get money from the house instead of paying into it.
In a sense, yes. You borrow against your equity. The loan balance grows over time, including interest and fees, and generally doesn't have to be repaid until the homeowner permanently moves out, sells the home, or passes away. It can help seniors supplement their income while staying in their homes. Takeaway number 4, navigating the landscape of mortgage types. Key choices are stable fixed rate versus variable ARMs. Then explore specific programs, conventional government-backed options like FHA, accessibility, VA, veteran benefits, USDA, rural areas, and jumbo loans for higher-priced homes. Each serves different needs.
Okay, this mortgage world definitely has its own language. It's full of acronyms and terms that can sound like Greek if you're not familiar. What are some of the absolute key terms we'll encounter that we really need to get a handle on?
You're so right. The jargon can be thick. Knowing the vocabulary is key to understanding what you're signing up for. Let's break down some crucial ones. APR, annual percentage rate. This is super important. It's not just your basic interest rate. The APR reflects the total cost of borrowing because it includes your interest rate plus other lender fees and points expressed as an annual rate.
So it's a better comparison tool than just the interest rate.
Exactly. Comparing APRs from different lenders gives you a much more accurate apples to apples look at the overall cost of each loan offer. Always look at the APR appraisal. We touched on this, but to reiterate, after you apply, the lender hires an independent appraiser to determine the fair market value of the home you want to buy. They compare it to similar recent sales. This protects the lender from lending more than the property is actually worth. If the appraisal comes in low, it can affect your loan amount or require renegotiation with the seller.
Right, the value check.
Closing. This term gets used in two ways. It can mean the whole process from accepted offer to getting the keys, which might take 30-60 days. It also refers to the specific event, closing day, when you sign all the final documents, the money changes hands, and ownership officially transfers. That final meeting. Loan estimate. This is a standardized 3-page form you receive from a lender within 3 business days of applying for a mortgage. It clearly breaks down the estimated interest rate, monthly payment, closing costs, and other loan features. Because the format is standardized by law, it's designed specifically to help you easily compare offers from different lenders. Review these very carefully.
Standard format makes comparing easier.
Good. Mortgage broker. This is an intermediary. A broker doesn't lend money directly, but works with multiple lenders to help find loan options for you based on your situation. They can be helpful, especially if your situation is complex, but you can also shop for loans directly with lenders yourself. Mortgage originator. Simple one. This is just the bank, credit union, or company that initially provides your loan, the entity you apply with. Mortgage servicer. This is the company you'll interact with after closing. They collect your monthly payments, manage your escrow account, handle customer service questions about your loan. As we said, often the originator sells the servicing rights, so your servicer might be different from your originator.
Okay, originator starts it, servicer manages it long term.
Points, or discount points. These are optional fees you can pay upfront at closing to lower your interest rate for the life of the loan. Typically, 1 point costs 1% of your loan amount. Paying points might lower your rate by, say, 0.25%. You need to calculate if the upfront cost is worth the monthly savings over the time you expect to keep the loan, the break-even point. Be wary of advertised rates that already assume you're paying points.
So it's a trade-off. Pay more now for lower payments later.
Precisely. Pre-approval versus pre-qualification. Worth hitting again. Pre-qualification is just a quick, informal estimate based on info you provide, no verification, no credit check usually. It means very little. Pre-approval involves the lender actually verifying some income asset info and doing a hard credit check. It results in a conditional commitment to lend up to a certain amount. Pre-approval is what sellers take seriously.
Pre-approval is the one you want before house hunting.
Definitely. Second mortgage. This is simply another loan taken out on a property that already has a first mortgage. Things like home equity loans, ACLOCs, are common types. They let you tap into your home equity without refinancing your primary mortgage. Title. Represents the legal ownership history of the property. A clear title means the seller has the undisputed right to sell, with no outstanding liens or claims from others. A title search during closing confirms this. Title insurance protects you and the lender against future title problems.
Makes sense. Ensures clean ownership.
Underwriting. We talked about this. It's that final thorough review process where the lender verifies all your financial details, the appraisal, the title, everything, to make the final decision on approving your loan application. It's the deep dive risk assessment. Takeaway number 5, mastering key mortgage terminology. Knowing terms like APR, true cost, appraisal value, closing disclosure, final numbers, points, rate buydown, and the difference between pre-approval strong and pre-qualification weak empowers you in the process. Don't be afraid to ask your lender to clarify anything you don't understand.
So what about the mortgage rates themselves? They seem to bounce around constantly. How are they determined, and what have they been doing lately?
They absolutely do fluctuate, sometimes significantly. The rate you personally qualify for depends on the overall market conditions, the type of loan and term you choose, any points you pay, and your individual financial profile, especially your credit score and down payment.
And we've seen a ton of volatility recently, haven't we? Seems like rates went from historic lows to painful highs pretty quickly.
We certainly have. It's been a real roller coaster.
Mm.
For context, back in 2020 and 2021, driven by pandemic responses, rates hit unbelievable lows. The 30-year fixed average was often below 3.5%, even dipping below 2.7% at its absolute lowest point. Unprecedented.
Wow, hard to imagine now.
Tell me about it. Then, starting in 2022, as inflation surged and the Federal Reserve began aggressively raising its target interest rate, mortgage rates shot up dramatically. The 30-year fix blew past 7% in late 2022 for the first time in 2 decades, and even touched nearly 8% in late 2023, a level not seen in almost 24 years. As of, say, April 2025 for our discussion, averages are hovering more in the high sixes for a 30-year fixed, maybe low sixes for a 15-year. Still significantly higher than those pandemic lows.
That's a huge swing, drastically changing affordability. So with rates moving like that, how can people effectively compare offers and figure out what they can realistically afford?
That's where careful analysis is key. An on-loan mortgage calculator is a really fantastic starting point. You can plug in different home prices, down payments, interest rates, and loan terms to get a quick estimate of your monthly principal and interest payment.
Helps get a ballpark figure.
Exactly. It helps you understand how changes in rate or price affect your payment and determine a realistic property price range. But, and this is crucial, always remember to factor in the other costs. Estimated property taxes, homeowner's insurance, your PITI, and any potential PMI if your down payment is under 20%. A comprehensive comparison means looking at the total estimated monthly housing cost, not just the P&I payment based on the interest rate. Use the APR and the detailed breakdown on the official loan estimate form from lenders for the most accurate comparison.
Right. Look at the whole picture, not just the shiny interest rate.
Precisely. That total monthly outlay is what truly impacts your budget. Takeaway number 6. Understanding mortgage rates and how to compare. Rates are dynamic, influenced by the market and your profile. Use online calculators for estimates, but always compare the full PITI payment plus any PMI. Rely on the APR and the official loan estimate for true side-by-side comparisons to gauge real affordability.
Okay, let's jump way ahead now. Imagine it's 15, 20, or 30 years down the line. You've made every single payment. What happens when you finally make that very last mortgage payment? That must feel amazing.
Oh, it absolutely is. It's a huge milestone, a really incredible feeling of accomplishment and financial freedom for most homeowners. When you reach the end of your mortgage term and make that final payment, you officially stop making those monthly payments to your lender for the loan itself. Done. They will typically send you some official paperwork confirming the loan is paid in full, maybe called a satisfaction of mortgage or a similar document. This legally releases their lien on your property. It signifies that you now own your home free and clear. It's truly yours, no strings attached to a lender.
Free and clear. So does that mean no more monthly housing costs at all? Smooth sailing from there.
Well, not quite zero housing costs, unfortunately. While that big mortgage payment, principal and interest, is gone, which is a massive relief, you are still absolutely responsible for paying your property taxes.
Ah, right. The government still wants its share.
Always. Now, instead of paying it monthly via an escrow account managed by your lender, you'll need to pay those taxes directly to your local city or county government yourself. This usually means making 1 or 2 larger payments per year, so you need to budget for that and remember to make the payments on time. The lender isn't handling it anymore.
Okay, so property taxes continue paid directly. What about homeowners insurance? Is that still necessary or recommended once the lender doesn't require it?
That's a great point. While the lender requirement for homeowners insurance disappears once the mortgage is paid off, it is still very, very highly recommended that you continue carrying the coverage.
Why is that? If it's not required.
Think about it. Your home is likely your single largest financial asset, and now you own it outright. Homeowners insurance protects that asset from potentially catastrophic losses due to fire, severe weather, liability claims, etc. Just because the lender doesn't force you to have it doesn't mean the risks disappear. Rebuilding a home after a major disaster would be financially devastating without insurance. It's just smart financial protection for your investment.
Good point. Protect the asset you worked so long to own fully.
Exactly. It's safeguarding your wealth. Takeaway number 7, life after your mortgage. Paying off your mortgage is a major win. You eliminate the principal and interest payment. But remember, you'll still need to budget for and pay property taxes directly. And maintaining homeowners insurance is crucial to protect your now fully owned, valuable asset.
Wow, we have covered a ton of ground today on understanding mortgages. It's definitely a complex topic, but so fundamental to personal finance and wealth building for many. Let's quickly recap our key takeaways one more time, just to make sure they stick with you as you navigate your own homeownership journey or planning.
Sounds good. Let's run through them. Takeaway number 1, the essence of a mortgage. It's a loan secured by real estate, making homeownership accessible, but the property's collateral until paid off. Takeaway number 2, navigating the mortgage application journey. It's a process. Credit prep, Pre-approval application, shop around. Underwriting, and careful review of the closing disclosure. Takeaway number 3, deconstructing your monthly mortgage payment. Remember, PITI, principal, interest, taxes, insurance, often with escrow, plus PMI if under 20% down, which you should aim to ditch. Takeaway number 4, navigating the landscape of mortgage types. Choose between fixed rate stability or ARMs, lower initial rate, more risk. Explore conventional FHA, VA, USDA, and jumbo options based on your needs. Takeaway number 5, mastering key mortgage terminology. Understand APR, appraisal, loan estimate points, pre-approval versus pre-qualification to make informed choices. Takeaway number 6, understanding mortgage rates and how to compare. Rates fluctuate. Compare total costs, APR, PITI, PMI, using calculators and loan estimates for true affordability. Takeaway number 7, life after your mortgage. Loan payments end, but property taxes paid directly. And recommended homeowners insurance continue.
We really hope this deep dive has demystified mortgages for you and given you a much clearer understanding of what's involved in buying a home. It's a huge financial step, no doubt about it. And being well informed, knowing the process, the costs, the lingo, that's your absolute best asset.
Couldn't agree more. Knowledge is power, especially with something this significant for your financial future. Take these insights, ask questions, do your research. Whether you're planning to buy soon or just building your financial literacy, being prepared really does make all the difference in making smart choices.
That's all for now, folks. Please like, share, and subscribe for more like this.